All right, today we're going to take a deep dive into a company called National Storage Affiliates. Now, on the surface, this self-storage company looks like an absolute dream for investors, and it's all because of one very, very big reason.
And here it is, a dividend yield of nearly 7.6%. I mean, come on, for anyone out there looking for income from their investments, a number like that is it's designed to grab your attention, right? It's a huge potential payout.
But that leads us to the big question, the one we're here to answer. Is this a genuine high-yield bargain, or is it a classic value trap where that tempting dividend is actually hiding some pretty serious underlying problems? Okay, so to figure that out, we've got to start with the basics. What exactly does National Storage Affiliates do? Well, it's about as straightforward as a business model can get. NSA is a real estate investment trust. You'll hear that called a REIT. And they're basically a landlord for storage units. You know the drill. They own the properties, you rent a space for your stuff, and they collect the rent every month. It's a business that tends to be pretty resilient because, let's face it, people always need more space. Simple, stable, and really easy to wrap your head around. But here's where things get interesting. When you actually try to figure out what this stock is worth, you run into a real puzzle. The numbers seem to point in two completely different directions. Okay, so on one hand, if you do a detailed analysis, projecting out all its future cash flows to figure out its intrinsic value, the math suggests the stock is really only worth about $28.60 a share. But look at the current price, $33.50. That means by this measure, it looks about 17% overvalued. Not a great start. But then you look at it from a completely different angle. You use another metric called the price to free cash flow ratio. And here you get a number of just 8.14. Now, a ratio that low is often a huge signal that a stock could be a potential bargain. So, what gives? So which one is it? Is it overpriced or is it a hidden gem? Well, to find out, there's only one thing to do. We gotta pop the hood and really dig into the health of this business. All right, this is our deep dive. We're going to peel back the layers on everything from its competitive strength all the way to its balance sheet. So we know the business is simple. But what about its competitive advantage, its economic moat, as they call it? What keeps competitors at bay? Well, the analysis says NSA's moat is just okay. It's moderate, not dominant. And that really helps explain this number you see at the bottom. Its 5-year average return on invested capital is just 4.21%. Think about that. For every single dollar it invests back into the business, it's only generating about 4 cents in return. That's pretty weak, and it's a huge sign of that limited competitive edge. And you can see that weakness showing up right here in its profitability. The trend is not good. Profit margins have been seriously squeezed, falling from an average of almost 15% down to under 9%. That is a significant drop, and it's a major red flag for any investor. Okay, so this pressure on profits makes you wonder, why is this happening? And that question leads us directly to the single biggest risk we found hiding on the company's balance sheet. And here it is, folks, a debt-to-equity ratio of 3.50. Now, to put that in perspective, this means the company is financed with 3.5 times more debt than its own money. A lot of investors start getting nervous when this number even gets close to 2, but for a REIT, which constantly has to refinance its debt, it's especially concerning. Think about it. In a world with higher interest rates, that debt can get very expensive very fast. This high level of leverage is the absolute central risk here. It just amplifies everything, both the good and the bad. So now that we've looked at the guts of the company, let's step back and weigh the risks against the potential rewards. This weighted SWOT analysis does a great job of summarizing everything. You see the good stuff, right? Strong cash flow generation, that high dividend, both positive. But look at the weighting. The two biggest negatives, that high leverage we just talked about and the low return on capital, they're given a combined importance that outweighs the good stuff. The final takeaway from this is pretty clear. It's an average quality company that's carrying some pretty elevated financial risk. This bar chart really paints the picture perfectly. That horizontal line shows you the current stock price, right around $33.50. And you can see it's already way above the base case valuation. In fact, it's creeping up towards the absolute best case or bull scenario. What does that tell you? It strongly suggests there just isn't much room to grow from this price. So after all that digging, it really comes down to the most practical question of all for an investor. What is the right price to pay for this stock? This table is all about being a disciplined investor.
Let's just say, for example, your personal goal is to earn a 9% return per year over the long haul, say 16 years. Well, to hit that target with NSA, this analysis shows you would need to buy the stock for around $23.10. Yeah, that's a long, long way from where it's trading today.
And what's really interesting is how that right price changes based on how long you plan to own the stock. Even if you're only looking at a shorter 5-year period, you'd still need to get in around $29 to hit that same 9% return. The lesson here couldn't be clearer. You have to be patient and wait for the price to come to you if you want to get the return you're looking for.
All right, let's put a bow on all of this and get to the final verdict.
So here are the crucial points to remember. First, that really tempting dividend, it's masking some pretty significant risk from all that debt on the balance sheet. Second, the business itself, it's just not a top-tier performer. Those returns on its investments are weak. Third, when you run the numbers, the stock is currently priced above its intrinsic value. And finally, if you're a disciplined investor who wants a solid 9% return over the long term, you really should be waiting for a price somewhere down around $23. You know, this one sentence from the analysis really just captures the whole story perfectly. This is not a distressed bargain, nor a superior compounder. It is a yield instrument that requires disciplined pricing. It's not a superstar growth stock, and it's not a dirt cheap deal. It's an income play, and whether or not you make a good return depends entirely on the price you pay. And that leaves us with one final thought. A question for you, really. When you look at your own investments, do you really know what might be hiding under the hood?